All right, hello, welcome. So let's dive into what forex is. We are going to be talking about the meaning of forex. This is really great if you are a beginner or you just want to refresh on what forex is. It is introducing you to the market and why we trade it, who are the participants, and all of those. So I am very excited to tell you why we are trading this amazing market. So let's get into it. So what is forex? First of all, if you have ever traveled to another country or even used another country's currency, if you had another country's currency, you have participated in the forex market. You have participated in the foreign exchange market. So you exchanging your currency for another is you participating in the forex market. So what is forex? Forex is the acronym for foreign exchange. It is just foreign for then exchange. It's not forest. I've heard a lot of forest, but it is forex. So the foreign exchange market, or you can shorten it to FX, is currently the largest financial market in the world. And I say currently because it currently is. Crypto is hoping to take over, but currently Forex is the largest financial market in the world. The FX market is a global decentralized market where the world's currencies change hands and exchange rates by the second they fluctuate. So what we mean by decentralized is it's not controlled by one party. It is controlled by multiple people. So you have to understand that in as much as it is regulated, but it's not controlled by one party, and you know that in a minute. So we have an exchange rate. What is an exchange rate? An exchange rate is simply the relative price of two currencies from different countries. So for example, one USD to one, what I say, to one naira. Okay, so 500 naira is equal to one USD. For you to own $1, you have to have 500 naira, as that's like now, in as much as the rate is fluctuating. So when the rate goes to 600 naira per USD, for you to get one USD, you have to have 600 naira. So for you to, now with this example of 500 naira per dollar, if you want to have $100, that means you need to have like 50,000 naira just to get $100. Same thing with other country. For €1, €1 is, let's say it is $1.02. So for you to have €1, you need $1.02. Does that make sense? So even GBP, Great Britain pounds, all of those things, for you to have that currency, the exchange rate matters. So it is those rates that we work with as Forex traders. So, but it is important to know that only a tiny percentage of the currency transactions happen in the real economy. So you traveling, doing all of those things, exchanging rates, going to another country, traveling to Maldives, going to Santorini, going to Dubai, all of those things are part of like foreign exchange. But most of what happens in the market happens on the charts. They happen for speculative reasons, and you would understand the people that participate in that. So they occur on a global foreign exchange market, bought and sold for speculative reasons. Currency traders, also known as currency speculators, buy currencies hoping that they will be able to sell them at a higher price in the future. So you will know who these speculators are in just a minute. Speculators. So the forex market is valued at over $5.3 trillion per day, and we'll elaborate on that in a while. So more on foreign exchange rates. The rates that the buyers pay in order to exchange their currency for a different currency, that is what the exchange rate is. And the rates change due to supply and demand. Due to supply and demand, we have the change in rates. So the more you understand just the basics of supply and demand, when there is high demand for something, the price goes up. When there is more of that product than demand, the price goes down. So yes, supply means a decrease in exchange rate. When the price of a currency is too high, they sell that currency. So that's the job of the speculators and all of those things. When the price of a currency is too high, it tends to sell, and market participants look for currencies that have more demand to buy in. So the entire idea of trading itself, or even business in general, is buy low and sell high. So if you want to buy something, let's say you want to buy a house, for example, you want to buy it at the lowest price possible, at the lowest price that you can get it. And when you want to sell the house, you want to sell it at the highest price that you can sell it at. So you don't want to be selling at a very low price and not get anything. So generally, that psychology plays out in the market. You want to buy low and sell high. Buy low, sell high. Now, when we get to technical analysis, you would understand which low and which high you are buying and selling at. So demand also, when there is a lot of demand for that currency, the exchange rate increases. So now, what is the brief history and how did the foreign exchange market start? How did it start? So you remember that time when you exchange goods for goods? That's called trade by barter. I just mimicked an ad, but it's called the bartering system. In those days, how people got to do business and get to like spend was spending what you have for what you need. So if somebody has what you need, you would exchange with that person. So people traded livestock, they traded their skills, they traded their talent, they traded people, they traded salt and different things. So if I had salt and you had a chair, I probably would give you salt for the chair. But you must need the salt. So that's one of the issues that came up with the bartering system. You know, someone, you have something that really no one wanted, and things had limited shelf life. So let's say you had like pineapples, for example, and you can't seem to find somebody that has pineapple, it would go bad. And a lot of transportation and storage problems, sometimes the exchanges were not fair, and it was really hard to repay debts then. So there were a lot of issues that came with that. Then we moved over to the commodity system where, we traded commodities. People used shells, rice, oils, all of those things. So as the world evolved, the way that we transacted, I'm saying we as if I was there then, but the way that money transacted and people were able to buy what they wanted for what they needed, it grew over time. So we entered into the coin age, where, let me move this. Okay, so this is where people had like these coins. So they started to produce coins, and these coins were made from electron, right? I don't think you saw. Let me see the last one. So you're able to see it. Asian China and India. So the coins were made from electrum, and it showed that people could now trade what they wanted for what they needed. So you could exchange a certain number of coins for what you want. So instead of waiting for someone else's livestock and all of those things. But they were too heavy to be carried. So that was another issue with that system. And now introducing paper money. The Chinese invented paper money, and they used it as a form of IOUs for private institutions to store their gold and silver in exchange for these paper notes and certifications. So the amount of gold that you have, you bring it to their storehouse, and then they give you the paper for that. So that receipt that, oh, I have 100 tons of gold here, and you have that. So once you have that paper, you are able to get your gold or your silver. The electrum was made out of gold and silver together. So now moving on to the gold standard system. So gold became widely accepted as a medium of exchange. So also they were too heavy. And in the 1800s, countries adopted the gold standard system. So what does that mean? So, but first of all, the gold standard guaranteed that the government would redeem any amount of paper money for its value in gold. So it wasn't just the Chinese anymore. We had like a government like in all countries. So people began to exchange paper money for gold. So at the end of World War II, such a long time ago, by the end of World War II, the whole world was experiencing so much chaos that the major Western government felt the need to create a system to stabilize the economy. So wars create chaos. And when that happens, governments will put different policies in place to stabilize the economy. So in 1944, 44 countries came together and created a system known as the Bretton Woods system. And the agreement says that's what we are currently running on. But if anything happens, governments can actually change policies again, and that would affect the entire markets, right? So the agreement sets the exchange rate of the US dollar against gold, which allowed all other countries and the currencies to be pegged against the US dollar. And this is why the US dollar is currently the world reserve currency, right? So that's why USD is king. USD is king, and what that did was it stabilized the exchange rates for a while. But a lot of major economies of the world started to change and grow at different speeds. So the rule of the system soon became obsolete because, I mean, why would I'm also a great country, I'm also a great, great regions. Why would they be pegging this thing against USD? So USD couldn't be king, although USD is still king. So countries inside Europe got out of it. So in 1971, the Bretton Woods Agreement was abolished and replaced by a currency valuation system. So with the United States in the pilot seat, that's why I said we're still kind of using it. The currency market evolved to a free floating system where the exchange rates were determined now by supply and demand. So at first, it was difficult to determine a fair exchange rate, but technologies made it even easier. So right now, we're no longer using Bretton Woods to correct that. we are now using supply and demand. But the US dollar is still a world reserve currency. So what does free floating mean? It means that where there is no standard rate and the exchange rates are determined by the level of supply and demand. That's why we have the exchange rate fluctuating all of the time. So meanwhile, thanks to the internet, some smart business-minded marketing people introduced internet-based trading. So now we took all of that trading, system and took it over to the internet. So we had internet trading platforms for individual traders like myself, like you, like so many other people. So these are known as retail forex brokers, and these entitles made it easy for individuals to trade by using smaller sizes, because only the big boys were allowed to participate in the forex market. But this is just an overview of how the forex market evolved from gold standards to major countries joining and all of that. I just added the charts, just added. So who are these forex market participants? Okay, I wanted us to go, all right, we'll go over brokers in a while, in just a little bit. But who are forex market participants? Who are those people participating in the market? Like we mentioned, only the big boys could trade the foreign exchange market before, but now almost anyone with a phone, anyone with a laptop can trade the market. So we have the government, the central bank, the financial institutions, hedgers, speculators, and we retail traders. So now the central banks. We'll go into details in the role of central bank in the forex market in the fundamental analysis course. So make sure you check that out. It's very important. So the news to pay attention to that the central banks control is interest rates decisions, central bank meetings, GDP, CPI, that's consumer price index. GDP is domestic gross. I said domestic. But gross domestic products of the entire economy, then the unemployment rates, the central banks like the FOMC, that's the Fed, central bank meetings, so the Federal Reserve for the US and every other central bank for each country. Then financial institutions like the commercial banks, like the top banks is, you have your JP Morgan, you have your HSBC, Goldman Sachs, the Dutch Bank, Barclays Capital, and these are all the countries flags. So these people literally participate in the forex market day in, day out. And the market share, though, as at 2010, the largest market share went to Germany, so the European market, but it has changed now. So they provide most volume that causes the market to move, and they are closed on holidays. So when they're on holidays, the markets rarely move. So during Christmas, during public holidays for that particular country. So that's why it's very important for you to understand the pair you are trading and understand the economy that is going on. Who are the people involved in that pair? So if you are trading the New Zealand dollar, or you're trading the Australian dollar, or you're trading any pair at all, you want to be able to pay attention to that economy when they have their holidays and all of that. USD now have a lot of holidays that go on, so these banks will be open. It doesn't mean the foreign exchange market will be open. It's just that US dollar itself might not make as much moves as it would usually do, right? So we also have large commercial companies, they take part in the foreign exchange market for the purpose of doing business. So for example, now Apple must first exchange its US dollars for the Japanese yen when it wants to purchase electronic products from Japan. So if Apple decides to purchase products, so let's say this is the period where they want to do manufacture, a new iPhone 100, 100X, iPhone 100X, and they go to produce. So they will take large millions, trillions, no, millions of dollars or billions of dollars and put it at once into the Japanese economy. It's going to cause yen to go up for a while. So, paying attention to all those things and understanding what really happened in that moment, that's part of fundamentals, right? So you want to pay attention to that. They are part of the market participants. And then hedgers. Hedgers, these are people that work for large corporations. They have clients from everywhere. They have clients from all over the place. And people, they invest money and then they trade for them in the interest of their clients. And these are large lot size. These are big boys in the markets. These are people that watch the foreign exchange market and they play in it with lot sizes like 10,000 lot size. Yes, 10,000, where you are getting like per lot is probably like $1 million per pip. So you don't want to play with that, or per pip is $100,000. So they really do move the market. They protect their companies from losses. So for example, they want to okay, so for example, they are working for a company and the company has plans like the Apple. The company has plans to buy stuff in the future, not now, maybe like in another 10 months time. They make agreements with the other economy to purchase that currency at this current rate instead of the future rate. So they are hedging against losses. So that's part of their job. Then we also have the speculators. These are sophisticated investors in the markets that they are trading. So they are experts in the markets that they are trading. Very important. So what they do is that they attempt to predict price movements in the more volatile sections of the market, believing or speculating that a high profit will occur, even if the indicators say otherwise. So if they believe that an asset will rise in value, they will buy a lot of it. And this activity of buying it drives the market price up. Now, speculators, they work for the banks. You keep your money in the bank. These are the people that say buy, sell, buy, sell. They work on Wall Street, all of those things. They are a department in banks or companies that trade money for their clients. So they work for major banks and they purchase. They are sophisticated investors or traders who purchase assets for a short period of time and employ strategies in order to profit from the changes in price. They are important to the market because they bring liquidity to the market and assume market risk. So it's just like retail traders, but these are the ones that pump money into the market. They trade with large, just like they hedge fund, hedge banks, edgers. They trade with large. I mean, imagine if a commercial bank is trading. Imagine how many millions people save in the banks, or people are investing in different places. Imagine how much millions they have to work with. So this is providing liquidity. Liquidity in the foreign exchange market means like we have a lot of money pumping in at that particular time. and it makes it to be a market that is well traded. That's why we actually trade forex. That's a good thing about forex, because there's enough liquidity in it to be traded. So that means you can trade back and forth, buy and sell, and do a lot of things. So these people are very, very important. So the difference between hedging and speculation means hedging means locking in future price due to reduce future uncertainty, right? The real hedging. But it's not like the hedging that a lot of traders do, where you buy and sell the same thing. It's just that one is just trying to limit your risk. But these are the what hedgers do for their companies. Speculation means having an unhedged position, so you're either buying or you're selling. So buying, take it, take advantage of future prices. Now we go to retail traders, independent traders, independent investors, aka Bolu Dennis, aka you. So that's you and me. We only make up 20% of the market, and we do internet trading, and we are at the bottom of the chain currently for the foreign exchange markets. That's what crypto traders are trying to do, that the power belongs to the people, blah, blah, blah. If you have a lot of people doing something, all of those things. I don't know if you heard about what happened with GameStop, a stock company called GameStop, where a lot of retail traders on reddit.com, they bought the stock at the same time, and that drove the price up because there was a lot of demand for it, and people were happy, all of those things. But that's just for one thing. Like, it cannot work with the foreign exchange market because we have government involved, government that handles the entire central banks that handle the entire nation's countries, governments move policies. So all of those things happen in the foreign exchange market, and we are at the bottom of the chain. So we don't move prices, we only check what the big boys are doing, and then we move with that. So as they move, we move. That's basically all we are doing with technical analysis and fundamentals, trying to understand what does this mean when they do this, when price moves like this, what does it mean? So by the time it moves, when you're trading, you know how to react to that. So thanks to the internet, in the early days, only the elite group of hedge funds, large banks, corporate institutions were allowed to participate. So between 1990 and 2006, the foreign exchange ROI was 9% more than bonds or equities or stocks. So to participate, one needed a million. Yes, you needed a minimum of $1 million to sign a bunch of documents just to open an account. But now, just having a good broker, you can just open with as little as even $10, $25, $50 to trade. And that's where leverage comes in. Your broker will offer you leverage. So if you're trading with $100, you'll be trading the market as if you have $1,000 in your account. That's how it's going to, the orders are going to fill in. So leverage is a good thing, and sometimes it's bad because you only have $100 and you're trading like you have $1,000. And if you over leverage, you know what will happen to your account. Go up in flames. Malano. So it is very important to know that retail traders don't move price. Our job is to find out what the big boys are doing and to follow them closely. So this is the hierarchy. See that we are at the bottom. Don't pass yourself. So now, with the internet trading, This created platforms, like we said earlier. These platforms were designed to stream live codes to their clients. So what they could instantly it turned to what they could instantly execute by themselves, like I explained. So you can open different accounts using different brokers. So what should you be looking for when you're looking for a good broker, right? It should be an ECN broker. We'll explain what ECN means in a bit. And it should have a good withdrawal method. They should also have load spread charges. They should also have an office where you can go to, because with the internet these days, anyone can just say they opened a brokerage firm. So you want to be sure of which broker you are using. So what is a forex broker? Getting a better understanding on what a forex broker is. This is a financial service company that provides traders with access to trade. And it's a platform where you can trade foreign exchange like we do. So personally, I can't recommend a broker for you, but what I recommend, what I use rather is I use either Xness. I use Xness. I use Xness as a broker, and I also use KOT. Yeah, because it's just good for me. They have like BTC withdrawal methods and all of those things. So a forex broker may also be known as a retail forex broker. So they are the ones that we trade through. You can't just take your money to trade inside the foreign exchange market. So what you do is you, with your phone and your device, you open a forex account, and then everything that you do, they are just like your bank. You deposit through the broker with whatever payment method they have, and then you open an account, log in with your MT4. So once you open MT4, you'll be able to look for that broker and then log in through that broker. So what's their role? The role of the forex broker. So first of all, one of their roles is to allow us to trade in other currencies. So your broker can offer you to trade in different currencies. Your broker can offer you to trade with gold. Some brokers trade stocks. Some brokers trade wheat and all of those things. So using a forex broker, a trader opens a trade by buying and selling, by buying a currency pair and closing the trade by selling that same pair. So for example, a trader who wants to exchange euros for dollars online, we are not doing anything physical. This is not a physical transaction. Like we mentioned earlier, most of the transactions happen for speculative reasons. So it's just you are clicking buttons. I mean, you are doing a lot of work, but it's just you are not doing physical transactions. We do use US dollar ultimately, but some South African people can use their currency. You can also use in Great Britain pound, depending on what your broker allows. So you will have the options there. How do you want to trade? How do you want the profits or the losses to be counting? So personally, I use USD. So that's how you say, oh, I made $1,000 off of this trade. I made $100 off of this trade. It's through the brokers that you trade. So if a trader wants to exchange the euros for US dollar, it buys the Euro USD pair online, and then this amounts to buying euros using USD. And then close the trade. To close the trade, the trader sells that pair, which is equivalent to buying USD euros. So not necessarily, you just click buy and sell. So if the exchange rate is higher than when the trader closes the trade, the trader makes profit. If not, the trader makes loss. That's basically how it is. So if you are buying something, you're expecting the price to go up. So if you closed and it has reached up, you are in profit. But if you buy it and then it sells, you are in loss. So now again, how to participate with the broker: you open a trading account. So they offer both the demo account, that's a practice account, so you don't have to first dive in with your live account. You can go in with your demo account first, practicing everything that you learn in your technical analysis, and then using that. Then they provide leverage. They give access to larger positions, or even with little capital, like I explained. Then they provide the live quotes, the same quotes that I'm using here, the same price of gold that I can see, the same price of USD that I can see. It's the same one that Donald Trump will see wherever he is. It's the same one President Biden will see. It's the same one anyone will see anywhere. So they offer the quotes. It's just that different brokers have different exchange rates. Sometimes it might just be like $1 or just one number or two numbers higher. So that's why sometimes it's not always the same, but basically generally they provide live quotes. So without barriers to entry, anyone could contact a broker and open an account, deposit money, and trade forex from the comfort of your home. Basically, you're working remote. And then brokers basically come in two forms, right? So you want to watch out for this when you're finding a broker. So we have the market makers, like their name suggests, they make and set their own bid prices. They can do that, it's very legal. Then you also have the electronic commissions network type of broker who bet against bid and ask prices that is available to them from all of these interbank markets. That's all the HSBC or the Goldman Sachs, and the prices those people are offering, that's what those broker will offer, instead of them just setting their bid prices. I would really recommend advise that for educational purposes that you go with one that has ECN. So how do these brokers make their money? Right? So they make their money through spread. This is the normal charge per trade. So once you open your trade, the first thing that occurs is you will see minus, and that is the spread charge. So depending on the lot size that you use, that's how the spread charge will count. So depending on that lot size I use, you get the spread count. So they also make their money through commissions and swap fees. Commission depending on the type of broker you are using or the type of commodity you are trading. So you can have, a different, if you're trading stocks, they might charge you higher commission. Some brokers don't charge commissions, some charge commissions. There are some type of accounts that you open that you have commissions, but it's just like little cents or little dollars as compared to what you want to do. So also charge swap fee. Swap fee is maintenance fee, really. If you open a trade today and you close tomorrow, as long as it's the next trading day, they will charge you for a swap fee. But it's really little cents and little dollars. So let's say $1 from like 10,000 clients in a day, that's $10,000. Yeah, it is actually one of my goals to open a rocket trend, a very good one that is free. So we'll see. They are regulated by the Commodity Futures Commission. So they are very regulated, and the National Futures Association. So now let's look at how big the forex market is as compared in comparison to others. So you can pause, take a breather, because we're about to go into how big the forex market is, and that is why we're trading it. So have a glass of water. Let's go on. So in comparison to others, So now this is the volume of the stock exchange market. So the New York Stock Exchange market is valued at over $22.4 billion per day. This is a average daily volume, daily trading volume. The Tokyo, which is Japan, is valued at 18.9 billion. The London Stock Exchange market is valued at $7.2 billion per day. This is volume, money that is being traded every single day. But the foreign exchange market is valued at over let's just go $5 trillion every single day. Every single day. I'm sure it has risen since then. So the world's perspective is, I just got this, all the money in the world, let's say it's $90.7 trillion. How is all the money $90.7 trillion when I own $100 trillion in Jesus' name? So the stock market has over 7 trillion. The gold market has market capitalization is 7.6 trillion. All cryptocurrencies is $250 billion. So crypto is just starting, just to chip it in there. Crypto market has a lot to catch up on. So if it gets like stable, get regulated, it's going to really have like a lot of opportunities in it. And the more people want it, the more it's going to stay. So just to chip in there, cryptocurrency is one of the major life-changing investments that one can make. But back to forex, the foreign exchange market cap, the entire market cap means market capitalization. It is the value of a company. So let's say a company's market cap and all of that. So the entire value of the foreign exchange market is $1.93 quadrillion. So put it in another way, it is 2.5 times larger than the entire world's GDP. And $5.3 trillion is traded every single day in the foreign exchange market. So you have $5.3 trillion that is moving every day. It is easy to get your own. That's easy if you know what you are doing. To get your own, just $10,000 per day, $100 per day, $1,000 per day, or even per week. So calculate this per week. That's over $25 trillion being traded every single week. $25 trillion passing. Don't let it pass over your head. Catch the pips you can catch, right? So if you spend $1 every second round the year, it will still take you 31,688 years to spend $1 trillion. So for you to spend $5 trillion, that's the daily volume, right, of the foreign exchange market. It will take you 126,000 years, 126,118 years to complete it. Even Noah, Abraham didn't live that long. Even Enoch was taken. But you get the point. Every day. So these are some fun facts about the foreign exchange market. The volume of the retail trading represents like 5.5% of the whole foreign exchange market. Forex trading daily volume is about 53 times more than the New York Stock Exchange market, which is the largest stock exchange market in the world, which is like investing in stock market. Foreign exchange daily volume is 53 times more. The Deutsche Bank, which is the visuals that we showed earlier, is the world's largest foreign exchange dealer. with over 21% of the market share. And there are over 170 different currencies around the world that make up the forex market. The forex market is the most liquid market in the world. And the forex market is 12 times larger than the futures market and 27 times larger than the equities, that's the stock market. So what is traded in the forex market? You can guess that right now, right? Currencies, money. What is simply traded in the forex market is money. Money. It's all about money. Okay, I don't have a good voice, sorry. Specifically, currencies. Because you're not buying anything physical with trading, forex trading can be so confusing, but let's simplify it a little bit. So again, to buttress our point of it being the most liquid market in the world with trillions of dollars exchanging hands every day. So the price of a currency is usually a direct reflection of market opinion on a current and future health perspective of the economy. So that's why you have to be very, very aware of the economy that you trade, and very, you have to be kept abreast of what is happening in that economy, the interest rates, the inflation, what the central bank is doing, what the president is doing when they're having their elections, things like that. You want to know how their seasonal things are, their natural disasters, all of those things. You want to know nothing just happens in the forex market for no reason. Everything happens for a reason, right? So in general, the exchange rate of a currency versus other currencies is a reflection of the condition of that country's economy compared to other economies. Write this, quote it, print it. This is it, right? This is what we are working with. The exchange rate of a currency versus the other country's currency. So we are trading it in pairs. You see in a bit. Is the condition of that country's economy. So what drives it, what drives the supply and demand of that currency is how the economy is performing as at that time, or projected to perform in future days. So what are the major currencies around the world? We have countries with the strongest economies. These are called major currencies. So you'll be hearing a lot of major and minor, but majorly these are major currency pairs. So we have the Canadian dollar, the GBP, Euro, AUD, JPY, NZD, USD. These are CHF. These are major currencies. So that means that they are heavily traded. They have enough liquidity, they have enough volume. You can make your money from them in a week. You can reach your goals, your PIP goals with this. So instead of trading like Ruby, SEC, all of those things that are not major or heavily traded. So currency symbols always have 3 letters, where the first 2 letters identify the name of the country and the third letter identifies the currency of that country. So usually the first letter of the currency's name, right? So yeah, in 1973, they established that 3 code letters for the currencies we use today. In stock markets, it's called ticker, a ticker for a stock company. So for example, NZD, we have NZ stands for New Zealand, while D stands for dollar. So like that. So countries and their currencies and their nicknames. So the reason why I have highlighted the nicknames is because when you start reading articles or you start reading the news, you start reading a lot, you'll be seeing a lot of analysts refer to all of these currencies by their nicknames. So when they are talking about the buck, you know, they are talking about the USD, or it's also green buck or buck, or Benjamins or anything. So it's just a nickname. So we have for USD, the country is the United States of America. The currency is the dollar. The nickname is buck. For Euro, it's the Eurozone, all the countries in Europe. Then we have the Euro currency. It's also called the fiber. Japanese, JPY, is the Japanese currency, and it's called the yen. The nickname is yen. Japan does not have time. GBP, Great Britain pound. The Great Britain, rather, the currency is pound, and the nickname is cable. CHF, Switzerland, and the currency is franc. So that's why we have CHF. Currency, why do we have CH? The currency is franc, and it is called Swissy. The nickname is Swissy. So the Swissy is this. You see it written a lot. So the Canadian dollar, CAD, Canada, and then the currency is the dollar, and the nickname is called the loonie. So you can say, oh, the loonie went up against the buck, all of those things. You already know what it is. The AUD, Australian dollar, the nickname is Aussie. NZD, New Zealand, the currency is dollar, the nickname is Kiwi. ZAR is South African Rand, right? South African Rand. I'm not sure it has a nickname. I'm doing research. So that's it for the currencies for now. So now let's move on to the trading sessions. So what times does the market move? The foreign exchange market moves 24 hours, 5 days a week. And that's one of the differences with the stock market. The stock market opened for 5 hours in the day. That's during working hours, and it closes during the day. The foreign exchange market is a 24-hour round the clock market. Crypto, on the other hand, is a 24/7 market. So when both forex and stocks are closed, the crypto market is open. That's why BTC moves on weekends. But forex, because of the banks and everything, closes on weekends and then opens on Sundays. So what are the three most important trading sessions? We have the Asian session, we have the London session, and the New York session. We also have Sydney session, which is what is here. So Sydney has to do with all the Australian, New Zealand, and all of those. New Zealand dollar, CHF. So this is when they open Nigerian time using GMT time. So by 10 p.m. Sydney opens. By 12 a.m. Tokyo opens. That's when JPY news usually comes out around this time, 12 a.m. London, 8 a.m. But you need to be able to be aware of daylight savings and daylight savings time. So London opens at 8 a.m. New York opens at 1 p.m. So 1 p.m., 2 p.m.-ish. Also be aware of daylight savings. And that's when, if you trade US 30 and all of those, you want to trade them during the US session. That's the New York session. So specifically high trading volume times that I've noticed, this is personally that I noticed in the market, that market makes a swing in different directions. And so around this time, 11 p.m. to 1 a.m. Nigerian time, during Asia. London, We have 6 a.m. to 7:30 a.m. pre-market. We have a little bit of movement there. 8:30 to 12 p.m. really. I personally do not open new trades around 11 p.m. And then moving into the New York session, there will be an overlap. An overlap is when two sessions merge together, and then they are running at the same time. So once New York opens at 1 p.m., that's 1 p.m. is during the pre-market time, 3 p.m. fully opened, 3 p.m. to 4 p.m. But when the market closes itself, is by the time they open at these times, the New York market, for example, will close at 10 p.m. Nigerian time. So when that closes, Sydney will open at 10 p.m. Sydney will close at like 7 a.m. or so. Tokyo will close at like 8 a.m. And then by 8 a.m. London is opened. London will close by 5 p.m. During that 5 p.m. US is opened, and round and round and round it goes. So now, finally, how can you participate in this market? First of all, take the entire course. I would recommend you take the entire course. Technical analysis, fundamental analysis, psychology, the strategy course. Take every single one of them before you decide to start like trading actively. So you will be able to get a good grasp of how to approach the markets properly. I have removed so many shafts. I've outlined it for you and detailed it well for the information that you need to carry out your journey. So make sure you pay attention. Do all the assignments. They might be tiring, boring, and all of those, but make sure you do them. Get disciplined. Get a good device and internet, preferably get a very good laptop to help you, and get personal development. So also take the personal development course, which is part of trading psychology, also very, very important, because trading is not for the weak. There's a lot of money flowing, but it can easily go over your head. You can easily give the market money. You can help them add to the 5.3 trillion. So it's 5.3 trillion point your $1,000. You don't want to do that. So make sure you get all the information that you need. Have discipline, have self-mastery. All of those things is included in the trading psychology course. So that is very important. Like I always tell my students, you guys know trading is 90% psychology, 90% psychology, 10% the technical analysis. It is 50% of how you master your mind, how you approach the market yourself, because it is an individual journey and you bring yourself into the market, right? 50% that trading psychology, the fear, the greed, everything, your thought process, how you handle everything, how you work hard, your consistency, your discipline, your focus, your level of focus, all of those things matters. How you react when you're in a losing trade, how you react when you're in a winning trade, taking away pride from it, always remaining humble, all of those things, they play out in the market. They are very important. Now, 40% for your risk management, how you don't over leverage so that your account will not go up in flames. So 10% the strategy that you are using. 100, that is for you to get 100% successful in this, you need all of those things in place. So you open a demo account. The IS for demo account should be $5,000. I know a lot of people open $1 million demo account and all of that, but you want to be realistic, right? And put money and then grow the account. Practice what you learned in all the courses. Backtest your trading plan. So how do you backtest? Is you go on your charts and then you just test it out. What you've learned, you go back in time and watch how price reacted to it. I'll make a detailed video about this and post on YouTube. So you want to also open a live account and you are in business. You are in business. Trust me, trading changed my life, and I am sure that if you pay attention to everything, it can change yours too. So that's it for this class. I'll see you in the next class. Have a wonderful time.